went up and even bond prices rallied. The only asset that went down was the US dollar. And that is, unusual. If a Federal Reserve does not pay attention to credit growth, you get that kind of situation. That's the problem, that the U.S. Federal Reserve officials, including Mr. Bernanke, they don't pay any attention to credit growth. And in America, during the period 2003 to 2007, credit growth accelerated from an annual rate of 7% to an annual rate of over 18%. And my view is today this: yes, we have a credit contraction in the private sector and the business sector, the household sector is suffering and so forth. And now the government, and I have to stress, exactly the officials that brought us into the existing problems today, they are supposed to lead us out of the problems with the same policy. In other words, after 2001, the Fed fund rate was slashed from 6.5% to 1%, and then kept at 1% until June 2004, and then they increased it, but at a very slow pace. And somebody may say, well, look, at that time there was no inflation, but that is not correct. Inflation can manifest itself in many different things. It can be consumer prices, it could be wages, it could be asset price inflation, such as real estate, or art prices, or stock prices, and so forth and so on. And now they've slashed the Fed fund rate again to zero, and what has happened? The price of oil has more than doubled.
Well, it seems that perhaps one of the transitions we have ahead of us as unemployment here in the States continues on a pretty nasty trail.
Correct.
Is that the deleveraging in the financial and bank industry, which is really what this quote-unquote deflation has been a part of, bank and financial balance sheet deleveraging, is now moving into the larger economy where individuals are looking at debt liquidation. Individuals are looking at their toys and their extra cars and the things that they bought on credit and now can't make payments on. Frivolous things that distract us, I suppose, but these things are now coming to market.
Yes, correct, but you have to see the origin of the crisis was overconsumption. And what drove the overconsumption? It was the credit bubble that allowed home prices to go up and allowed people to borrow against their homes more than they should have. And this was, again, encouraged by the Federal Reserve. Mr. Greenspan gave several speeches in which he applauded the subprime lending industry. Partly it was also a consequence of government policies to allow minorities and underprivileged people to borrow and so forth. But largely it was a mistake of the Federal Reserve. And what disturbs me most in the current environment, and I'll address the question of inflation and deflation in a second, what disturbs me the most in this environment is that the same policies are applied today that brought about the problems in the first place, with the same people in charge, basically. You just pointed out Goldman Sachs. Now, I'm not sure that Goldman Sachs rules the world or rules the U.S. government, but for sure they're very powerful.
I would encourage you to take a look at the Federal Reserve Bank of New York, their main website. Recent speeches, you'll find the William Dudley speech. And
yes, exactly.
I think as an academic, it'll make you spitting mad. You just look at it and you wonder, how is he president? How is he CEO of the Federal Reserve Bank of New York? Because it is totally irresponsible. The idea that we can implement the same policies, just goose them, if you will, or put them on steroids, so the same policies put on steroids, and that's somehow going to solve the crisis. Yeah, you're right. We go back to the basis of overconsumption and what allowed for overconsumption to occur, and you do end up hanging the scarlet letter on the Fed.
Yes, I mean, look, the problem is not just the presidents of the Federal Reserve banks in the United States. If you read economists like Mankief of Harvard or Krugman, take as an example Krugman. In March of this year, he said the following: to be honest, a new bubble now would help us out of a lot, even if we paid for it later. This is really a good time for a bubble. There was a headline in a satirical newspaper in the U.S. last summer that said, "The nation demands a new bubble to invest in." And that's pretty much right. The problem is you don't solve problems with new bubbles, you create even bigger problems. Because if you look at the last few bubbles the U.S. had, we had a bubble essentially in 87. That was a minor bubble. Then we had the S&L crisis, which was more severe. Then we had essentially the tequila crisis, then LTCM. The bailout of LTCM was a huge mistake, in my opinion, by the way, because it encouraged risk-taking. Then we had the NASDAQ bubble. But the NASDAQ bubble was concentrated in a narrow sector, in the TMT sector. In other words, technology, media, telecommunication. And it didn't affect household wealth to the same extent that a housing bubble affects the household wealth. Because everybody basically owns a home. Not everybody, but say close to 70% of families in the U.S. own their homes, whereas not close to 70% of U.S. had money in the NASDAQ. So I think that the next bubble will only help. And by the way, I have a bubble that is now being created. The next bubble will only help if it's even more gigantic than the previous bubble. And when it bursts, the next big crisis will occur. And for that, I don't see a solution. Now, the next big bubble, I think, is in government spending. I think Mr. Obama is dreaming if he thinks that the deficit next year, which this year will run at, say, $2 trillion, that the deficit next will come down. I think it is likely to be even bigger next year. And so my view is in the long run, these deficits will be monetized, and when the time will come, when the Federal Reserve should increase interest rates to essentially combat price increases or protect the value of the dollar, they will not be in a position to do so, or will not wish to do so, because, you understand, as the government debt grows, the interest expense on the government debt goes up. It's going to be, in a year's time, around $500 billion annually. Now, if you then increase interest rates, then obviously the interest expenditure on the government debt goes up and the deficits don't come down.
Dr. Faber, question for you. We have enjoyed the luxury of the U.S. dollar being a reserve currency for many years. And, when you're talking about the next bubble being government spending, you've pointed out recently in your writings that the private sector jobs have grown about half of what the public sector jobs have grown. So that just adds to your argument as far as the government spending being a bubble. What happens if the dollar no longer is respected as the reserve currency, or do you see that happening?
Well, I'm not sure it will happen in the near term, but very clearly, in the very long run, the dollar will be a weak currency. Now, the big question is obviously the response of other governments, because other governments are also as good or even better at printing money than the United States. Mm-hmm. And so maybe all paper currencies go down in value. And when they go down in value, they go down in value because inflation is in the system.